Hello, traders. FS Picoletta here. Today is Wednesday, so happy hump day, and it is October 29th. So, how is everybody doing today? Hopefully, everybody's doing fairly well. A little bit of a sideways market today so far, not a whole lot of action, but you gotta kind of expect that a little bit on days where you have FOMC coming out. So, later on today, in about 30 minutes, we got FOMC. We have federal funds rate, which they are planning on lowering the rates 25 basis points, as you can see. If they do lower the rates 25 basis points as they predict that they're going to, it may not be that big of a surprise to the market. It may just be, it potentially may have already played into the market. It might not be that big of a deal. So, yeah, we'll see. So, we got pretty big news events. So we're going to focus on the dollar um, until then. Uh, okay. So anyways, yeah, we got the federal funds interest rate coming out in about 29, 28 minutes, and then we have the press conference. We got Powell talking after that, which actually I forgot to pull that up. I'm gonna have to do that before the FOMC starts. So we're gonna spend about 30 minutes looking at the dollar pairs, including gold. We're gonna try to focus on the US dollar index and see if we can figure out what is likely going to happen. So we'll take a start off. As always, I like to start off on the US dollar index. I'm a big believer that if you can kind of figure out what the US dollar index is doing, and yes, I know that most people do analyze the DXY and they have very, very, very similar patterns, and almost exactly the same pattern. But I do prefer the US dollar index just because it is equally weighted. The DXY is 57% weighted to the euro dollar. It's like literally the exact same chart as the euro dollar, but in reverse, basically. So if I'm trying to figure out what the dollar is doing, not like the euro dollar in reverse, then I much prefer to look at the US dollar index. So on the daily time frame, there's a few different ways to count this. And in my members Zoom meetings that I do twice a week, twice a week we do 2 hour meetings with my members where we try to figure out these patterns and try to work together to try to solve the problems of these markets. There's a few different analysis that we're working with, and honestly, I don't really think it matters that much whether we call it one or the other because the outcome is basically the same either way. A lot of people are calling this right here a wave five. I don't have that as a wave five just because this to me over here looks like the wave five because that's definitely an impulsive move right there. A wave five should be an impulsive move. To me, this right here is not an impulsive move. That is definitely a three-way pattern. That's definitely impulsive, corrective, and impulsive. So it's definitely 1, 2, 3 pattern to the downside. So starting right here, we have three waves up, we have three waves down, we have three waves up, we have three waves down. So that's why I have it labeled as a WXYXZ, or it possibly could be like an ABCDE. Oftentimes, ABCDEs and things like that do play out in three-way patterns. So I think that we are potentially still good. Now, the difference is a lot of people are saying that this right here is the wave five because this is the lowest low, which I do agree that is the lowest low. And a lot of people are saying that this is a flat, like this is an ABC flat pattern. Now, the results are exactly the same, whether it's a WXYXZ or whether it's an ABCDE or whether it's an ABC flat. This first little box right here is my target for a running like a running ABCDE or a running WXYXZ or a running flat pattern. So as you can see, price last week did spike up into the box right there. It just barely came up into the box, hit it, and it definitely looks potentially like it definitely did hit the target zone. So if this is a running flat, then we potentially could already have the high in. And if this is actually a WXYXZ pattern, then you would expect this to be three waves. And you could definitely say that this is 1, 2, 3 waves up right here. So this potentially, my one analysis is that this is a wave one, this is like a wave two, and it's going to eventually go down for a wave three, which lower interest rates would kind of make you think that the dollar would keep going down. The second box I have up here is way up here is if it's an expanding flat or an expanding WXYXZ pattern. So, the 178 or the 161.8 is the target for that. So if it does, make another higher low, higher low, higher low, higher low, and just keep on trending up, then that would be my second target if it goes beyond this first target. So definitely a little bit of a tricky market lately, in my opinion. Now we can't really deny on the daily time frame that the trend is up. The trend is definitely up. We got a higher low, we got a higher low, we got a higher low, and it looks like the market is trying to make another higher low right now at the 61%. So this could potentially just be higher low, higher low, higher low, higher low, and it could go up, make higher lows, higher highs, higher lows, and higher highs. So we are definitely still in an uptrend on the daily. We cannot deny that. And this move down to me does not look very impulsive. If this really was the end of a Kretsen, then you would expect to see like a one, two, three. It would have to be very, very impulsive to the downside, which in my opinion, it's really not impulsive whatsoever. So I think that there's a good chance that the dollar is still bullish. I actually still think there's a very good chance that the dollar is going to keep on going up. So if I think the dollar is going to keep on going up, then that would have to make sense on all the dollar pairs themselves also. In my opinion, it definitely makes a lot of sense on the euro dollar. I've been saying this for several weeks now, but I think that the euro dollar is either in an expanding ABC, which would put us all the way down to here, or it's possibly a running ABC, which would target this area right here. But we have lower high on the daily, lower high, lower high, lower high. We are sitting right at the 61%. This could potentially be another lower high that could go all the way back down there. Yeah, we're going to cover all the dollar pairs, but basically the US dollar analysis is telling me what I think is going to happen on all six of these major dollar pairs. I do not include gold because gold does not always follow the dollar index, and I don't really include the dollar yen either because that's almost more of a yen pair. I think the yen drives that more than anything. So I think there's still a pretty good chance that we could get a big push down. I still think that this move up right here is a pullback to this move down. Now, that doesn't mean that the news might not come out and it might not go up and grab liquidity from all these highs and then turn back down like that. That definitely seems like it could be a very, very likely, possibility. But I do think that it's not going to take out these previous highs. Even if it does go up, I think it's going to make a lower high and end up going back down again. Which honestly, I'm still kind of wondering if the news has already played into the market. Maybe the market has already made its turn. Maybe it's just going to take off from here right to the downside. So I am definitely still very bearish to euro dollar for sure. So going up to the daily time frame. So on the pound dollar, I need to take what I just learned about the euro dollar and I need to apply it to the pound dollar. Now, the pound dollar is a little different because the pound has been quite weak these last few days, which is causing the pound dollar to already be down. But if the dollar is going to go up, then the pound dollar is potentially going to keep going down. If this is a regular flat, then I'm definitely targeting this area right here. If it's an expanding flat, I would probably target this area. We can't deny also on the daily time frame that we got lower high, lower high, lower high. Yes, I really wouldn't want to try to go short right now on this pair. I would actually prefer to already be short on this pair, which I'm not, but I mean, if I was, I wouldn't be trying to go long, and I honestly wouldn't really be trying to go short either. Like I said, the pound dollar is down because of the pound. It's not down because of the dollar index. So there's a chance that this might even just take right off and just keep on trending down. A lot of the times you do get these big old spikes at the news, like liquidity grabs. So, there's a chance that it might go up initially and then start working its way down at the press conference. So we are sitting at a fib level. That does act as support a lot of the times. And if it does turn out to be a running, there is a chance that it turns right here. I mean, it is definitely possible. If it does, go up and break structure today, then we definitely will start looking for logs tomorrow because that probably would mean the end of a Kretsen and probably would go back up. I still think there is a chance that the pound dollar does go all the way up to about 1.5 over the next several months, but we don't really know that for sure. So, anyways, Aussie dollar. Aussie dollar is quite different also because of the Aussie. We don't have as much correlation between the pairs as we normally do. A lot of these pairs are moving independent of each other, which can make it a little more difficult. The pound dollar is down because of the pound, the Aussie dollar is up because of the Aussie. Same thing with the Kiwi. The CAD is moving because of the CAD interest rate news we had today. Swiss is kind of doing the same thing. To be honest with you, the Aussie dollar kind of looks like it's a ended an ABC correction and it potentially is back into an uptrend. So I would be pretty bullish on the Aussie dollar, but it doesn't really make sense to me for this to just continue up if the other pairs are going to continue down. So I've been contemplating whether this is potentially like some sort of a flat right here. Maybe this is like going to be like a running flat and it's going to turn back down. Maybe this is really like a wave one, wave two, and it goes down for wave three or something. So I'm still kind of debating whether this is potentially just going to keep on going down or not. So, anyways, Kiwi dollar, same type of thing. The Kiwi dollar is actually one of the ones where I was like, this is actually really does kind of look like a possible expanding. We got one, two, three waves down. We got what looks like one, two, three waves up. And then we got lower lows, lower highs, basically, for the most part, all the way down to the 61%. And then we turned back up very softly. But we have not broken structure, right? We don't know that this is the end of an ABC correction right here until we get that nice solid break of structure right there. If we get that nice solid break of structure right there, then it probably is the end of a pullback. And this Kiwi dollar analysis is very similar to the Aussie dollar analysis, as in I still think there's a chance that this thing could go up a lot over the next year or so. And the Aussie, the Kiwi are very correlated. With have a lot of they move a lot based on China, and depending on what happens in China, that could be what causes this to be bullish. So honestly, I still think there's a chance this could make another lower high and push down today. I'm still pretty bearish on this. I still think there's a very good likelihood that it could go down. The US dollar CAD is another one where, like I said, we're kind of losing correlation between the dollar pairs, in my opinion. A lot of times the dollar pairs are very correlated to each other, but the US dollar CAD is going down strong today because of the Canadian news that we had. It's not really going down strong because of the dollar. If you look at the dollar index is actually up today. Well, it's up a little bit. It's kind of a doji day so far, but it's definitely not going down like this is. Yeah, we can look at oil and stuff like that, the pound yen after the dollar news comes out. Once that comes out, I'm going to start taking requests from people. So if anybody does have something they want me to look at, definitely put it in the chats. I'll be more than happy to check it out. To be honest with you, the dollar CAD, I feel like is potentially just finishing a wave A. I feel like it could potentially do this over the next several weeks, and then end up doing this. I think we could possibly be in a wave A of B right now. This is an A, this is a B, this is a C, and then it potentially goes up like that. It makes a lot of sense for this to make a more proper looking pullback to this whole five ways down on the daily. So that's kind of what I would expect to see out of that one. It's kind of tricky because still think that the dollar could turn bullish, and I don't really feel like I'd want to try to go long on the at the end of this big old impulsive move that we had today from the Canadian news either. So kind of a tricky news event in my opinion. I mean, I could see the possibility of this already being the end of a pullback and just continuing down from here, but I think it would make more sense for this to make a wave B over the next several weeks and then go up for a wave C. So it feels to me like we're in a wave A, and the wave A is not really complete yet. It needs to make like a wave B and then a wave C and then go up like that. So we'll see. I mean, if they don't change interest rate, like if they keep it at 4.25 or potentially they do something other than the 25 basis points, that's when we potentially could be seeing like a really, really big move in the market. Um, but yeah, we don't really see any of that yet. So, anyways, yeah, let's move on to the US dollar Swiss. This is another pair that I was talking to some of the people in my group with about what potentially could be going on here. Um, Stefan was saying that this looks like an ending diagonal, which I could picture that being possible also. The only reason why I don't really think that the downtrend on the Swiss is over yet is because of the Swiss. If you look at all the Swiss pairs, every single one of the Swiss pairs has been in a downtrend pretty much for 50 years now. So I have a hard time believing that this is going to turn up in a big way, which is why I have it labeled as a WXY, even though I don't actually have the WXY on there. Let me put that on there. So I still think this is a W, this is an X, and I still think there's a chance this could go up for a wave Y. If it doesn't go up today, then that's definitely going to invalidate this analysis. And to be honest with you, the weekly time frame, this Fibonacci retracement is from the weekly time frame, and that's why I still think that it's going to go down here. So a lot of times when you come up with counter trend analysis from like the weekly time frame, a lot of times you'll be like, oh, this is going to go up and make a this, and then it's going to go down and do that. A lot of times what happens is it just goes down anyways and doesn't really go up and make the more proper pullback like you would be expecting. But to me, it seems like it's making a WXY. I think this is an A. I think this is an expanding wave B, and I still think this is potentially going to go up and make a C, and that would be your ABC of Y, which is what I've been saying in my videos these last couple days. But if that's true, then this needs to be impulsive today. This pretty much needs to be a wave one, this needs to be a wave two, and this needs to go up for a wave three in order for that to be true. If it doesn't do that, then it might invalidate this count. Kind of almost looks like this is a flat right here in the middle too, doesn't it? It's kind of a weird pattern. Almost like this is like a one, this is the two, or something like that. But yeah, and yeah, the gold and the dollar yen, I don't really base on the dollar index like I do all the other dollar pairs. I am definitely looking for a turn down on on all the yen pairs. But I'm really not convinced that the dollar yen is over yet. Now, from the end of the last pullback right here, it looks like a one, two, three, four, five pattern, right? It looks like five waves up. A lot of times when you see five waves, you automatically are like, oh, look, that's five waves. It's going to go down. It's going to break structure. But because we're not at a Fibonacci level, and because of most of the other yen pairs, I still think look like they could go up one more time. I still think there's a chance that this could go up one more time also to hit the 78% Fibonacci retracement. Then if it turns down, then that definitely could be the end of a pullback. I also see the possibility that this is just going to keep going up too on the daily, on the weekly. I mean, my original analysis was that this was going to go down to either the 100% or the 161% for the for like a more traditional ABC or like a running expanding ABC that is. But it made impulsive down. It made three waves up. It made impulsive down. I mean, it looks like a traditional three-wave pullback. It might actually just go up and up and up and up and make a new high. Which, to be honest with you, I think would make a lot of sense when you're thinking about it as a dollar pair because I still think that the dollar index needs to go up for the rest of the year. I still think that this is an A. I still think it needs to go up and grab this high right here for a wave B, and then I still think it needs to go down for a C. So if the dollar index goes up for the rest of the year, right into the beginning of next year, then the dollar yen might actually go up and make a new high before it actually turns down again. I still think it would make a lot more sense for this to not be an ABC, but for this to actually be a WXY. If you look at the DXY, it probably does make more sense on the DXY only because this is basically the same thing as the euro dollar. But I would say this could be one, two, three waves down for W, one, two, three waves up for X, one, two, three waves down for Y. No problem, Big Tony. Appreciate the support. Definitely make sure you like and subscribe and everything like that so you don't miss out on my future videos and stuff like that. I do enjoy helping people, and I really enjoy the community aspect of my Discord group. I mean, I've been in a trading community pretty much my whole trading career, and if it wasn't for other people in the community, I would definitely not be nearly as successful at trading as I even am. So, being a part of a community, in my opinion, is extremely important. I used to have a free community on Discord, but unfortunately, because of all the scammers, I had to get rid of it because they were scamming people in the group pretending to be me. But I still have a group, but it's a paid group. It's only $30 a month. But I do share all my trades with the group. I share my analysis with the group every day, and it also comes with a trading course. So if anybody's interested in that, definitely check out my website. It is only $30 a month, and you get a lot of benefits. I really try to encourage people to share their analysis with each other because that's how we all grow as a community, is when people share their analysis. Even if you're a brand new trader, sharing your analysis can sometimes really shine a lot of light on the situation. As far as gold is concerned, I personally think gold is finished three waves of A, is what I think. I think this is an A. And if you go down to probably the 4 hour time frame, it might be a little clearer. I definitely didn't recognize this pattern. Other people in my group did. This little pullback right here, now in hindsight, I can see what it is, but at the time, that was kind of a tricky pattern. It was a contracting triangle, like an ABCDE, but at the time, I definitely didn't see it at that. So what I see is I see an impulsive down, and then I see a contracting triangle in the middle. So I see an A, and then I see like a contracting triangle wave B, and then I see another downtrend for what looks like a wave C. So I think we got three waves of A. And because the wave two on the higher time frames is a very complex, is a very traditional pattern, I mean, it is kind of stretched out a little bit, but for the most part, this is basically just a three-way pullback. And it's also not very aggressive. It's kind of sideways and not really that deep. More than likely, this wave four is going to be a complex pattern. More than likely, it's going to turn into like a WXY or some sort of a triangle, like an ABCDE, or maybe even like a WXYXZ or something like that. So on the 4 hour time frame, I think that we've completed three waves of A. I think this needs to go up more. I think we're in the A of B, probably going to go up around these highs someplace, and then probably down again, and then probably up again. And this is probably going to be your three waves of B. So I think we're going to have three waves of A, three waves of B, and then we're either going to have three waves of C or maybe five waves of C or whatever it decides to do. It's very hard to forecast a complex correction, because there's a lot of different varieties of complex corrections, especially if you're talking about the triangles. It could make a expanding, a running, a contracting. It could do pretty much whatever it really wants to do for sure. So, anyways, still pretty bullish. I still think this is potentially going to go up a little more. Maybe it's going to go up at the news and do something like this. This is kind of what I would expect to see. I would expect it to go up around this area right here to finish off the A, then potentially make a wave B, and then potentially go up again for a wave C. Anyways, I gotta get the PAL speeds queued up too. I forgot to get the PAL speeds queued up. Let me do that real quick, even though the speech doesn't stop for 30 minutes, but I want to have it ready so we're ready to go. So let's see here. YouTube. The news comes out in 8 minutes. So here we go. Already 1,000 people waiting. Yeah, right. So the PAL speech is all ready to go. That is potentially when the market is probably more likely to make a big giant move is when the PAL speech starts, which starts 30 minutes after the news release. And right now, there's only 4 hours difference between London and New York, which is why the news is coming out at 6 p.m. London time instead of 7 p.m. London time. I'm pretty sure the U.S. changes their clocks on Sunday, this coming up week, right? Yeah, this coming up week on November 2nd, the U.S. changes their clocks. So next week, it's going to be 5 hours difference between London and New York, like it normally is, which is good because it kind of throws your schedule off a little bit. So long term, my gut says bullish dollar. Short term, I really wouldn't be surprised if it went down first. It's a very tricky looking little pattern, in my opinion. Like I said, I mean, potentially this is already over. If this is not a flat and it's actually like a WXY or WXYXZ, whatever you want to call it, then it definitely did go up into my target zone, and it could potentially be a wave one, it could be a wave two, and it could just go down for a big old wave three. But just because of the structure, I mean, it's higher low, it's higher low, it's higher low. I still think there's a chance this could go up one more time. Still feel like it needs to go up and grab these highs and potentially maybe even go all the way up to this higher box, which would grab the highs of the wave four, which is obviously this is an important area over here because look how strong it went up over here and then it just reversed back down. This area right here seems really strong and then it lines up with the 178, 161%. And if this really is like going to turn into some sort of an expanding, then the 161, 178 would likely be the target area for that zone. So the question is should we enter a trade before the news? Should we just wait for the news? Sometimes I do enter trades before the news, but it's kind of gambling To be honest with you, it's not really any different than going to the casino and just putting all your money on the roulette table when you do that because you could potentially be right about your threats in, but it might go up and make like a 50 pip spike or something like that before it actually goes. You could go short, be right about the threats in, put your stop loss way the heck out of the way, and then it goes up, stops you out, and it goes into your threats in. So yeah, I mean, like I said in the past, I definitely have entered before the news, but it's kind of gambling. I was thinking about doing it today just because I had a fairly decent day. I made, I don't know, 30, 40 pips at like $10 a pip today. So I was thinking I was thinking about entering and risking some of the money that I made today on the news, but that's kind of a bad idea most likely. It's gonna could possibly cause my winning day to turn into a break even day, which is not good. So hmm. DXY, yeah, it's hard because to me this looks like an impulsive move. And this also looks like an impulsive move. Maybe it's not going to be a big giant mover. Maybe this is either an A or one, and today, and then this is like an A, and this is a B, and it's going to go up and make a C, and then it's going to turn down like this and make either a wave three or a wave C. Like today, it's going to go up, and then maybe like later on this week, it's going to start working its way down because it looks like an incomplete pattern, doesn't it? It bounced from the 61%, but it never broke structure to the upside, so we can't really say that the trend is back up. Technically, the trend is down on the sort of time frames. Hey, Bucky. Hey, Menu. Hey, AG. AG, how's it going? Nice to see everybody. Thanks for stopping in. Could be a pretty interesting day. I think last FOMC meeting that really wasn't that big of a mover. Sometimes you get some huge, huge moves, and sometimes you don't. It really depends, I guess. It depends a lot on what Powell says too. We only got about 2 minutes until news comes out too, so if you are planning on entering, I guess now would be the time to do it. I don't know. I personally am bullish the dollar because of the higher time frames. And even if it really is like a wave A and a wave B, and then it goes up and makes a wave C, then that would still be bullish dollar. And then maybe tomorrow or something, it would turn back down, like I said, for either a 3 or a C. Like this would either be a 2 or a B, this would either be a A or a 1, and then down for either a 3 or a C. Well, at least Powell's on time. Every time Trump has some sort of speech or something, he's usually like 30 minutes, 45 minutes late. So at least Powell comes out on time when he's got a speech to do. The fact that it's already going up kind of probably makes you think that it might go down a little, but I'm gonna stay out, I guess. I might get tempted to enter something after the news, but I think the best thing to do right now is to stay out. If the euro dollar does go up and then start looking like it's gonna come down, I might go short, but that would probably be after the news, not during the news. Not before the news, that is. It really looks like a pullback to me, doesn't it? I mean, this looks very, very, very corrective, and this looks very impulsive. So, but the market might not make it that simple. It might not just take off like you would like it to. It might go up and stop everybody out before it goes. And gold makes me think that it's going to go up and finish off a wave A. So I don't know. Definitely got a little bit of a loss of correlation between some of these pairs. I still think that gold's going to end up doing something like this over the next several days. We got about 30 seconds until news comes out. I'm gonna watch the euro dollar just because that's kind of the main currency. This is the euro dollar has more liquidity than any of the other currency pairs, so definitely kind of the one to watch. So here we go. About 10 seconds. Let's get this ready to go. 3 seconds. I even logged into my trading account. Mm, starting to move a little. Definitely not a big old giant push, is it? 25 basis points. So they did what they forecasted they were going to do. Boy, the euro dollar might just keep going down, in my opinion. Boy, my broker is acting different than Oanda. Huh, that's weird. Wow, yeah, look at that. Jesus, my broker is acting way different than Oanda. Jesus. That's the only problem with forex sometimes is it's not a central exchange. Sometimes one broker to the next will have a little bit different price. Unlike the stock market has a central exchange, so the price is the price, no matter what broker you use, basically. With forex, it can definitely be a little bit of a difference between brokers. Like my broker, just my European Oanda broker, just moved down dramatically, while this one wasn't. This is the U.S. Oanda. This is the Oanda for UK and US. I have to use the TMS Oanda, which is the European version of it. Definitely not a whole lot of price action, is there? Is gold pushing up? Boy, I really feel like gold's gonna go up. Boy, I bet that's sitting at a fib level too, isn't it? Oh yeah, look at that, 61% fib bounce. Man, maybe gold would be a better trade than the euro dollar if it starts to move up. Not a whole lot of price action, is there? Wow, pound dollar is barely doing anything. Aussie dollar is still pretty strong up, leading diagonal. What's that on gold? If it's a wave A, then a leading diagonal could make sense. Definitely. Oh, there it goes. There goes gold. Gold might be the one to get in, honestly. Like I said, I would be targeting this area up here for gold. That's probably, when you're talking about gold, that's probably a lot of pips too. Yeah, it's about, I don't even know, a lot of pips. 1,400 pips. I don't know if I would call that a leading diagonal. Maybe it is, but leading diagonal, the wave one should be the biggest wave. I don't really think the wave one is the biggest wave in that circumstance. Nah, yeah. The wave three, the third wave is bigger than the first wave, so I don't think that's a leading diagonal if that's what you were talking about. Hey, Yanberry, how's it going? Nice to see you, buddy. How's everything been going? Haven't heard much from you this week. Not really missing much. Jeez. We have to wait and see what Powell has to say, but man, there's not really a whole hell of a lot going on right now, is there? Powell's going to be out in about 25 minutes, so I guess I could start taking some requests. Markets have definitely been slow. So, a guy in our group posted earlier today that there was a 97% probability that they were going to lower rates, and they did lower rates. So obviously the market already kind of knew what was going to happen. And then the next interest rate is December, and there's like an 87% chance they're going to lower rates again in December, according to that chart. And maybe now the interest rates are out, maybe they'll finally get the government going again, because a lot of people are saying the only reason why they kept the U.S. government shut down for so long is because of they didn't want all this bad news to come out. Hopefully they do get it going because starting November 1st, I forget the number, but like 40 million people are not going to receive food stamps because the U.S. government's going to be shut down, including children. So a whole bunch of families that don't can't afford to feed their children are not going to receive food stamps in November because the U.S. government is shut down. And plus, a lot of government employees have not received a paycheck in several weeks, and they're still working basically for free. Man, I almost went short on the euro dollar too before the news. I was like right around here. I was like, man, I almost went short right there, but I was like, it's probably going to do a spike reversal before it goes down. But I think it might just keep going. I know, pound dollar. The pound went down really hard today, but that was all because of the pound. If you actually go and look at all the other pound pairs, that whole move is definitely a pound move. The pound Swiss went down, pound CAD went down strong, pound Aussie is down, pound Kiwi is down, pound yen is down. Yeah, we'll see what Powell says. I'm kind of interested to see. Normally, I don't really give a crap what he says, honestly, but he's definitely gonna probably talk about the government shutdown and talk about that a little bit. I honestly think the dollar could keep going up overall, but it doesn't mean that it might not finish a move down before it goes up. I don't know. It's hard to say. Powell's always dovish, isn't he? Oh, really? He posted that chart earlier saying there was like a 87% chance that there's going to be a rate cut in December also. But I think it really is going to depend a lot on it's going to depend a lot on the numbers that come out over the next several weeks. Even like there's still no U.S. news coming out. You know, we haven't had job reports, we haven't had unemployment reports, we haven't had a whole bunch of news hasn't been coming out. That's why I'm going to be kind of interested to see what Powell has to say because a lot of that news is what they base their decisions on. So, does anybody have some requests? We got about 25 minutes or so until the Powell starts talking. So I'm more than happy to look at other things. We already looked at all the dollar pairs pretty intensely. Oh, the gold didn't hold its move, did it? It's probably just stop hunting people. I don't think it's gonna go down and break structure. I mean, it definitely could. I guess it is technically in a downtrend, but well, yo, Aussie, I feel like it needs to stay bearish. We're at a major support area though, aren't we? Maybe we're getting ready to start like a wave two or something. Definitely very choppy price action for sure, Skywick. I think this is either an A or one on the daily. I think this is a big wave A. This is a WXY or B. This is a C. I think this is either a B or a two. And I think we're either going to go down for a C, which would make a higher low and go up, or we're going to go down and break structure, which would confirm that this really is a top on the higher time frames. Kiwi Swiss, that's a pair I almost never look at, but I'm more than happy to check it out. If it breaks structure, then it pretty much proves that this is a top and that this is not a 1, 2, 3, but it's actually more of an ABC like Menu and I think Philip and a few other people were saying, which I'm more than happy to agree with them if once the market proves it. But boy, they might be ready for a pullback, huh? Maybe not. That's a pretty strong wave right there to just end. It's probably more likely in like a wave four. Maybe it'll go down and hit the fib level for wave five, and then turn up and start a little bit of a bigger pullback, and then go down. Yeah, probably needs to complete like a pullback for sure. It's probably gonna make a pullback to this last impulsive move down, isn't it? Like a little boop boop boop, and then down again, and then maybe break structure. Yeah, this is the Yo Aussie. It's definitely impulsive. I think it's either a C or a three. There's no doubt about that. Oh wow, look at the Yo Kiwi. That thing figured reversed hard. I haven't been paying it that much attention. There's definitely been some swing trades available on some of this stuff. I've been talking about how swing trading has been difficult this year, but boy, you could have got it down here and held on to it for 3 weeks, got out up here. You could have got in here, held on to it for 3 weeks, got it here, held on for 3 weeks, gone short here, held on for 2 weeks. There's definitely been some swing trades. Maybe not on the dollar pairs quite so much, but on some of these other pairs. So more than likely, this is the same thing that I haven't been keeping up with my analysis on this one, but more than likely, this is a wave B. And more than likely, we're going down for a wave C, like a one, two, three, four, five, a B. That's weird though. It's like a five-way pullback, but either way, it's like Yenberry said, it's impulsive. So I don't. I think it would go down, take out the lower wave A eventually. So I would definitely be focused on shorts. That's for sure. If it breaks structure to the upside on the 1 hour time frame, then I would throw my Fibonacci retracement on the last impulsive down and look for more pullbacks to go short again. And if you're like a really short time frame trader, if you get a break of structure, then maybe you can try to scalp some longs, but they would definitely have to be scalps in my opinion. Yeah, I can look at the Aussie Kiwi for sure. Ooh, this might be getting close to a turn too. It's not a very big wave four if that's what it is, but boy, this might be getting very close. This could be a huge swing trade if that really is what it is. I wonder what would cause the Aussie to turn down so strong though. Like this to be an A, this to be a B, and then it goes down, makes a big old giant wave C lasting months. Something pretty big would have to happen to cause that, I feel like, on either the Kiwi or the Aussie. Probably something to do with China, no? If I had to guess, it would probably have something to do with China. Yeah, the Feds definitely could do it for sure. For now, I mean, depending on what time frame you're on, I mean, I would definitely still be bullish on this for sure. That's probably more likely the three right there. And if it goes up and then eventually turns down and breaks structure, then I would definitely be bearish in a huge way at that point. But for now, oh wow, look at that, man. That's been Jesus Christ. Maybe I need to stop worrying about the freaking dollar pair so much, huh? Jesus. Even like I used to trade the 4 hour time frame only, and boy, I know it requires a lot of patience, which is why I don't do it so much anymore because I have a group and people follow along with my trades. So people don't want people don't want to join a group and only see 2 to maybe 4 trades a week tops. They want to see 2 to 4 trades a day, if not more. But boy, life is so much easier as a swing trader, in my opinion. You go long there, higher low, higher low, higher. Oh, look, lower high. Oh, yeah, I'll get out there. Go long here. Oh, yeah, I'll get out there. Go short here, get out there. Powell's headed to the Caribbeans. I think it's kind of funny that Trump was so giving Powell so much hell about doing all that work to the Federal Reserve building, like all the work that is getting done, and now he's literally tearing down the whole west wing of the White House or whatever wing it is to rebuild it, spending billions and billions of dollars to rebuild the White House west wing or whatever wing it is. You don't really hear much about it too. They kind of feel like they're kind of keeping it quiet. They're not really talking about it too much. Aussie and Kiwi are definitely awesome. I used to love the Aussie and Kiwi. I just feel like it's harder when you live in Europe and the UK to trade them because oftentimes they turn in the Asian session, and if I'm in a trade and I'm sleeping, and then they turned in the Asian session, then I potentially could miss an exit, or I could potentially miss an entry. Like if I'm long or something, and it turns in the Asian session, I might miss it. But honestly, when you're trading a 4 hour time frame or something like that, then you're not really going to miss that many trades because you should be available for every single candle except for maybe one candle a day. Years ago, when I traded the 4 hour time frame, I used to set an alarm for 2 o'clock in the morning. I would get up at 2 o'clock in the morning, I would check my 4 hour candle close, and then I would go back to bed. But the problem with that is sometimes you would enter a trade and then go back to bed, and you'd be laying in bed thinking about, oh man, was that a good idea? And next thing you know, like 2 hours would go by, and you're not even sleeping because you're thinking about the trade that you just entered. But if you were dedicated enough, you could see every single 4 hour candle close throughout the whole week. And you would never miss an entry and you would never miss an exit if you saw every single candle close. Oh man, dollar's going down, up. I mean, you think gold's gonna keep going down? I mean, technically, the market flow is down on gold. These are the charts I actually trade on, and I've been recommending shorts, and I still am recommending shorts to my members because it hasn't made an engulfing up at a fib level or anything yet. So I've been recommending shorts ever since the big move down, and technically, until it goes up, it's still technically shorts. But based on Elliott Wave, I still feel like it needs to go up again, though. US dollar yen's moving. Dollar yen is moving pretty decent, isn't it? Let's see. Did I miss? What did I miss today? I went long on the euro dollar a couple times today, so I didn't miss much on that. Pound dollar, I didn't go short, but that's because it happened during the Asian session. There definitely was a long opportunity on the Aussie dollar today that you could have taken. There definitely was a long opportunity on the Kiwi dollar you could have taken, trading with the trend. As you can, I follow the daily time frame, so if the daily time frame is up, that's what I'm doing. I'm looking for longs. Definitely could have gone short at the news on the U.S. dollar CAD. That definitely would have been a good trade. Yeah, US dollar Swiss would have been tricky. You might have been able to get a couple pips here and there, but definitely not the. Oh, that's right. I did go short on the dollar Swiss today. I went and I got out. That's right. I did try to take that. I went short right here and then got out before the move up. Gold. I'm still technically recommending shorts on gold. I mean, technically, you could have gone short probably right there and been sitting in some pretty nice profit. I've been recommending shorts on the US dollar yen because of the daily time frame, and you definitely could have gone short a couple times on that. So every single morning, the first thing I do every single morning is I do this members forecast for the JPY basket, the US dollar index, and all the dollar pairs and a handful of the yen pairs. And I will tell you what direction I recommend trading. And every single morning I do that. I recommend what direction to trade for my members. And those are the trades that you potentially could have taken today. You know, there probably was a short there. You could have gone short there. I would same thing on the the euro yen. I was recommending shorts. There could have been a couple shorts on that. Wow, there was definitely a couple shorts on the pound yen you could have taken today. A couple longs on the euro dollar you could have taken. Definitely a short on the pound dollar you could have taken. Definitely a long on the Aussie dollar. Definitely a long on the Kiwi dollar you could have taken. Definitely a short on the dollar CAD. There definitely was some pretty good trades today. I've been kind of scalping the euro dollar today, trading $10 a pip on my own personal account and being really, really aggressive with my exits. Like if I get in a trade and it doesn't go immediately, then I get the hell out because $10 a pip can add up pretty fast. So being really aggressive with my entries and my exits. I haven't even been trading my funded account in like 2 weeks. I've only been trading my personal account because I really do believe that everybody's goal should be to have your own personal account. How do you know that, wouldn't you prefer to have like $1 million personal account than $1 million funded account? I definitely would because how do I know that that pop firm's not going to go out of business at some point? And then next thing you know, if they go out of business, you're going to not have any trade account anymore if you don't have your own personal account. And the more you trade, the more your broker will give you discounts too. Owanda gave me a 30% discount on my spreads last year because they called me a high frequency trader because of how much I trade. And if I trade even more, they give you even a higher discount on your spreads. So the more you trade, a lot of brokers will give you benefits. I know Owanda will give you that level two stuff if you trade a lot, the level two price stats and numbers or whatever you call that. I don't even really know how to use that, but some people swear by that stuff. Gold does look like it wants to push up still. Risk is king. Risk on, risk off. The markets. I haven't looked at the stock markets. We got about 10 minutes until the news comes out. Is the stock market still up? Oh yeah, it's definitely still up, isn't it? Whew, unreal. Does anybody remember back in January when everybody was like, "Oh, Trump's gonna crash the stock market. Trump's gonna crash the stock market." When you have a president that is a capitalist like him, he is probably not gonna crash the stock market. At least not on purpose. Man, oh man, oh man. I should have literally just taken every penny I had and just bought, and now hold. I feel like that's the only way to trade these things. I know a lot of people do day trade the indices, but man, I feel like the way to go is just every single time it goes down, buy with no stop loss. Just buy, no stop loss, buy, no stop loss, buy, and then bam, you're rich. It's definitely the way to go. Crazy. Wow, the UK stock market is on fire too. The DAX isn't really moving up like that. The Euro stock market is at all-time highs. The French stock market all-time highs. Aussie stock market all-time highs. Ooh, Chinese stock market looks like it wants to go down. That looks like a potential A B right there. It looks like it could go down. Yeah, I can take a look at Bitcoin. I'll just do this. I have Bitcoin on my list, but I haven't been watching this either. Oh, that could be an expanding. Oh, I even have it labeled as that too. That could be going, possibly could be going back up. Does kind of look like a possible either A, B, C, D, E, or possibly expanding, doesn't it? Especially with these three waves up right here in the middle. That looks like it could go up for sure. Well, I mean, I can't say for sure, but it looks like it could go up. Oh, oh, it's because of these closed. That's because this is Oanda. I was gonna say, why is there big old gaps? But it's because Oanda Bitcoin closes on the weekends. Even though cryptocurrency doesn't close on the weekends, Oanda cryptocurrency does close on the weekends. 50%? Yeah, we're sitting at the 50% Fibonacci retracement if that's what you're talking about on Bitcoin. I would be looking for a long, definitely. I'd be looking for either a break or structure to the upside at a Fibonacci level, or I would be looking for at least a nice engulfing move to the upside or something like that. Like right here, you get the break of structure, and then look what happens. It comes back and retests the break, and then goes. So probably the best thing to do is wait for the break of structure, wait for the retest, and then get in on the retest. Definitely a much safer way to do it. That's what I used to always call the bread and butter trades. You wait for a break of structure, or you wait for like a break of a trend line or a channel line, and then you wait for the pullback to retest of the break of the channel or the retest of the break of structure, and then go long. Those are probably the safest trades you can get in, the break of structure pullback entries. Oh, really? Is cryptocurrency and gold correlated that much? I have no idea. The best thing to do when you're looking at Bitcoin is to look at other cryptos also, especially these total ones. Oh wow, that does look like it wants to go up, doesn't it? I forget which one's Bitcoin though. This one is crypto. This is the Bitcoin one, total two. That definitely does look like an impossible expanding type thing, doesn't it? It's hard not to be bullish on crypto, even though we're pretty close to all-time highs. Yeah, I didn't really know that. You might be right though. It doesn't really. I mean, I could be wrong, but that it's going up now. It could turn into a more complex pattern, like a more complex correction, but is gold pushing up yet? I thought it was going to go up. No, it might not. Maybe not. Like I said, I mean, even though my Elliott wave says potentially up on gold, My structure analysis, I've been recommending shorts on gold for the last 2 weeks to my members every single day. Like I said, every single day, the first thing I do every single morning is I do this. And it's very, very simple analysis. It's only based on the daily time frame structure and the daily time frame market flow. This morning I posted this chart, and this morning I said the trend is down based on structure. Market flow is also down because the recent candles are making lower lows and lower highs. Because of this, I recommend looking for shorts on sort of time frames. The 1 hour, you could go lower than the 1 hour, but the 4 hour to 1 hour time frame. If price makes an engulfing up and takes out the orange line, then I can start looking for longs. It never did go up and take out that orange line, so this is, like I said, this is the first thing I do every morning at 8 o'clock this morning. I posted this. Has there been any shorts today? I mean, yeah, you definitely could have gone short right here. The last year or so, I've been, I love Elliott Wave because I do believe that if you can correctly label the past, you can correctly predict the future. I'm a big believer in Elliott Wave. But over the last year or so, I feel like structure analysis is kind of king because all the big money players know Elliott Wave. They know every single strategy that exists. They definitely know Elliott Wave. Sometimes you'll see like the most perfect pattern, Elliott Wave pattern, and then it fails. And if you were doing nothing but following structure, then you probably would have been short, and you'd probably be sitting on some nice profit right now. Like I said, every single morning, the first thing I do is recommend what direction to trade. The gold I was this is not gold. This is the pound yen. I've been recommending shorts on the pound yen, shorts on the euro yen, shorts on the US dollar yen, shorts on gold. This is literally how I trade. Like this members forecast right here, I only trade in the direction that I recommend people to trade in. I'm looking for shorts on the US dollar CAD, and there was definitely some really nice shorts on the US dollar CAD today. This is, like I said, the first thing I do every single morning is this numbers forecast, so that way I know what direction I should be trading in for the rest of the day. So if anybody is interested, like I said, my membership is extremely cheap. I only charge $30 a month, and that also includes, all the trades I take. It includes the trading course, the members forecast, the members only Discord group. So it definitely comes with a ton of benefits. So if anybody is interested in that, definitely check it out. It's not a signal service. I have so many people join the group and like, when's the signal? Signal, signal. It's not a signal service. It's a community of traders that are helping each other out. I do share all my trades with the group. That's why I call it Learn and Earn, but this is not a signal service. Nobody is ever going to get rich following somebody else's trades. It will not happen. Show me one trader that has become rich from following somebody else's trades. I don't think you can. So we got Powell starting his speech very, very shortly. I think I would have to be bullish on Ethereum and probably solo. I mean, I don't really know. I don't really follow crypto. I've never traded crypto in my life. I own a tiny bit of Bitcoin just because I got some free Bitcoin like a year and a half ago when I signed up for a account with Public so that I could buy UST bills. All the money that I make from trading goes into UST bills, even though right now T bills aren't paying that great because interest rates are going down. But all that money goes into T bills, and then once I make enough money, I am going to build a log cabin house in America, most likely next year. So all my money is sitting in T bills right now. I've never traded crypto in my life. Not one time have I ever entered a trade on crypto. So let's see what let's see what Powell's doing. I want to listen to the speech today because I'm kind of interested to see what he has to say. Oh, I don't want to hear that though. So we're gonna listen to see what Powell has to say. Maybe draw a bead on him, draw him smoking a doobie and stuff like that. That's one of my favorite things to do. Keep myself occupied while he's talking. Do this, do that, do that. See what old Powell. Oh no, I don't want full screen. I still want to watch the dollar pairs a little bit and see what he's up to. See what Powell has to say today. It should be starting any minute here. All right, here we go. See what he has to say. All right, I'm not going to talk during the Powell speech.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion in your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month, and maybe today, I won't go fortune about, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation, and then that has changed now. And as we saw particularly after the July meeting, we saw downward revisions in job creation. We saw a very different picture of the labor market and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them is calling for you to hike and one of them is calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's a driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that that we haven't made a decision about December. I always say that it's a fact that we don't make decisions in advance, but I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the US Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, the place we're trying to reach. Well, what we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened. Some things have been happening for some time now, showing a gradual tightening in money market conditions. Really, in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be freezing the size of the balance sheet, and the December 1 date gives the markets a little bit of time to adapt.
Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested the labor market strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, and we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market. And the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah, so we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things, but I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views? Was this a close call, this cut, or was it a close call maybe the other way because you had the sense on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecast for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
Just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in treasury bills, which will foster both a more treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we'll be we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers, and also do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs, and that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news, that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services, and that's kind of been moving sideways over the last few months. But a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple of things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be 5 or 6 tenths, and so that if it's 2.8, then core PCE not including tariffs might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case, and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be one-time inflation. We understand fully this is a risk we have to monitor and ultimately manage.
With the stubborn services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say that first.
The stubborn services inflation that you mentioned.
Service inflation. Yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because the Fed policy is modestly restrictive. So that should also help get that. I want to say though, we're absolutely committed to returning inflation to 2%. If you look at longer term surveys or market pricing, you will see that that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber, Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. And big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run. It's longer run assessments that this is an area where there's going to be a lot of investment and it's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up, you mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense, I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the beige book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with our Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the lack, the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the beige book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up, in the debate in this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to be possibly going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs. And much of the time they're talking about AI and what it can do. So we're watching that very carefully. and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are if you listen to the earnings calls or the reports of big public consumer facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower cost products, but that at the top people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there. So,
Edward. Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction in rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspective is on people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
So on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have in fact cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates, and we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were, and that should help, so that at least the labor market doesn't get worse. So it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand, and that we should use our tools to support the labor market when we see this happening.
You also talked about tariff causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation, because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths, maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public view sample people. Inflation is still very much making people quite unhappy, even and it's nice that that prices are not going up as fast as they were, but they're still much higher than they were, and it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At at the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not, it's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here to, by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these are ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing, and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers, or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy is growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown, and of course that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, so I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting, we're getting, a better flow of data, but if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital when I said that in 2020 was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
We do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, and again, we didn't get the September employment report, payroll report, but we look at the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, in no story, you can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is that you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger headcount. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't. Our tools don't allow us to target any demographic or any income level, that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do. for people, along with keeping prices stable. Those two things. I mean, inflation also hurts people on fixed incomes more than other people.
Hi, Chair Powell, Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel. Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions. And you just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings? And if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing. And as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people. But they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time. And I believe we'll get through this and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last one. Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop. It wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. And you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
Okay, it is over. Let's turn this off. All over. Pretty decent moves though. All trend trades too, by the way. Let's look at this real quick. Pretty much every single one of these moves was a trend trade too. By the way, like I said, I've been recommending shorts on gold, even though my early wave count was more bullish. I've been recommending shorts on gold. So if you did take this short, that was definitely a pretty good trade. Euro dollar, very strong move down. The trend has definitely been down the whole time. Market flow turned up for a few days, but the trend is definitely down. Pound dollar, really nice push down. So pretty much every single one of these moves was a trend trade. Aussie dollar was a little counter trend, and Kiwi dollar, but US dollar CAD, yeah, the Canadian news was definitely the Canadian interest rate news was definitely a trend trade today. So, like I said, every single morning I do recommend direction to all my members. First thing I do every single morning on Discord, I tell everybody what direction I think they should be trading in throughout the day. So, if anybody is interested in checking that out, definitely do check out my website. Like I said, it is Learn and Earn, because really the purpose is for you to learn to trade, not just to take other people's trades. But I do sell all my trades at the time of entry. Been kind of day trading the euro dollar this week. Anyways, let's see. We do have to be a little bit cautious with some of these moves. I still think that the euro dollar on the higher time frames, I still would be targeting for a running flat. I would at least be targeting these three Fibonacci levels. For an expanding flat, I would at least target these levels. So maybe the move is done for the day, but I think overall it's probably going to drift down more. I don't think this move is finished. So that should tell you on the sort of time frames that you should be looking for pullback entries still. Definitely wouldn't be trying to go short right now. The pound dollar did tap into my 90% area just recently. Now, if it's a regular flat, it can go down, which I think it is because the way B turned it to 90 also. So if it's a regular flat, then you would be looking at the 100% Fibonacci extension way down in this area. But anyways, within this box, if we get a break of structure on maybe a little bit of a shorter time frame, then it could be a complete trend reversal. The whole thing with the pound dollar is, though, that the weekly time frame, the only dollar pair that has broken structure is the weekly time frame is the pound dollar. That means that this possibly could be a complete trend reversal. The pound dollar could be in a downtrend now for a very significant amount of time, possibly. Maybe for the rest of the year, maybe part of next year also. Aussie dollar. I kind of have a hard time believing that Aussie dollar is just going to turn into a downtrend. Maybe it will go down. Maybe it will make like a 78% pullback or something, but it seems like it should at least make either a three-wave up or possibly another impulsive up. So overall, I would be looking at this as possibly a pullback within an uptrend on shorter time frames. Definitely could look for shorts in the meantime. Like I was saying, I think the Kiwi dollar is going to end up making like a double bottom possibly. Then if it turns up and breaks structure, we'll be happy to start looking for longs, but definitely shorting the Kiwi dollar on sort of time frames on pullbacks. US dollar CAD is a little bit of a difficult one for me because my Elliott wave makes me think that this is going to do something like this over the next week or two, which would be like a corrective wave B, maybe sideways up and then down for the C and then up for the bigger wave C. So overall, I think direction could be down, but it might drift up potentially and sideways for a week and then down, impulsive, maybe down into this area, and then potentially up to like the 50 or the 61%, something like that. Yeah, I think people would like to hear your opinion in the chats menu. I don't know. I thought for sure the wave A was already over on gold, boy. I've been talking about this WXY analysis for over a week now in my videos. 3 waves of W, 3 waves of X, and now we got an A, we got an expanding wave B. I think we're in a 1, 2, 3, 4, 5 up for a wave C, which should at least take out the high of wave W, which would put us almost up to the 0.82 area. So I've been, like I said, I've been talking about this for like a week or more in my videos. Definitely looks like the pattern is playing out. I thought for sure gold was done with its move down, but the thing is if this really is a contracting triangle, like we were talking about yesterday in the Zoom call, if this is a wave one, wave two, wave three, then this could be a wave four and a wave five. But the problem I have with that count is that if this is a contracting triangle, then this should be an A, B, C, D, E. This should be an E wave. It shouldn't be a wave two, which means that this would be your trend. So I think there's a chance this could make a higher low. I don't know. It's tough. Let's look at it on the 1 hour time frame. Yeah, real quick. Gold has been a little tough. Honestly, it looks like an ABC on the 1 hour, doesn't it? Looks like it's going back down. It probably is a wave four, which means maybe this is just a contracting like ABC instead of a ABCDE. I don't know, because that means this would be like a wave one, wave two, wave three. Looks pretty impulsive, but maybe there is some sort of a pattern in here someplace. Post your thoughts on Discord menu so we can see what you're thinking, because I don't really know exactly whether it's going to keep going down or not. Dollar yen, I honestly think the dollar yen is going to push up to the 78% before we see too much resistance to the downside. I do, I've been saying in my videos all week long that this looks like a 1, 2, 3, 4, 5, which it definitely does, but I think it's going to stretch out for a little while to at least the 78%. Markets usually almost always turn at a Fibonacci level, and the fact that we're right in between two Fibonacci levels is a major red flag. And the fact that I'm still pretty bullish the dollar overall makes me think this is going to keep going up. Somebody was saying something about the pound yen, I think. And the whole thing with the pound yen is that this could be an ABC right here. Yes, there's a gap right here that hasn't been filled, but this potentially could go up for 2 weeks and then go down in like a month from now, fill the gap. It doesn't have to fill the gap now. The break of structure is right here. If it goes up and breaks that structure, then that's a break of structure at a Fibonacci level. That's an ABC, and it would continue the uptrend. If it doesn't break structure to the upside at a Fibonacci level, then it's probably not actually that. Oh yeah, let's take a look at oil real quick for you. I saw that you requested it earlier, so definitely want to check that out for you. I thought that oil was potentially finally starting its move up, which I still kind of think it is. Look at the weekly. I mean, the weekly definitely looks impulsive. This looks pretty overlapping. It looks like it's trying to make a new impulsive. I still think oil is potentially going to go up to either $88 a barrel or maybe even $100 a barrel over the next 6 months or so. Maybe even higher. But boy, a break of structure would have been nice to help confirm, huh? There's a break of structure right here that has not happened yet, and without that break of structure, it's hard to say for sure that it's really going up. It could potentially reject this structure and go down again. So, based on structure, the trend is down. Until you get a break of structure, you can't really confirm that this is a bottom. But to me, it does look like a bottom. It looks like a 1, 2, 3, 4, 5 for sure. Yeah, I don't think that the dollar's finished going up, Adrian. Right, Andrew. I think it's going to keep going. Like I said, the thing with oil is there's no confirmation of an uptrend yet, which means that anything you see to the upside could potentially just be a pullback within a downtrend. So just keep that in mind. I don't know what time frame you're trading. If you're trying to swing trade it to the upside, which is honestly what I kind of wanted to do, just get in a trade and then let it run for 6 months and not even think about it. But this break of structure is what I'd like to see. I'd like to see a break structure and then pull back to structure and then try to go along and hold on for like 3 months, see what happens. Yeah, I don't know. I think the dollar's going to keep. Oh yeah, well, there is a chance that this is an ABC, but I don't know. I mean, if it starts to turn engulfing to the downside, then it might be an ABC. It might go back down, but I think that's the 1 hour time frame just being deceiving. I think the daily is the true story, and the daily I think is still pretty dang bullish. And I think it would make a lot of sense for it to grab some of these liquidities. I think it potentially could even grab this wave 4 liquidity eventually. So I honestly think that it could even end up doing something like this over the next, but it might just, go up to like the 100%, grab this area, and then turn back down or something. We'll see. So anyways, make sure you like and subscribe. Definitely check out my website if anybody's interested in that. Is very, very cheap membership. Make sure you like and subscribe. I try to do these live streams every Wednesday, and I do Zoom meetings every Tuesday and every Friday for my premium members also, including the members forecast and sharing all my trades with the group at the time of entry. So check out my website, fxspeculator.com, if you're interested. Just hit join now. If not, definitely make sure you like and subscribe so you don't miss out on my future videos and live streams. As always, thank you for watching and happy trading.